Hello guys, this is Castaway Trader and welcome back to my YouTube channel. So here you see a home page of my new website www.castawaytrader.com. Before we start that video, I would like you to read that important disclaimer. Okay, first of all, I want to refer you to my old video posted last year in April 2018, where I explain how I normally trade options. So this video will be using the same technique, so if you want to get more details, you can come back and rewatch this video. So let's look what happened this week. On February 4th, I tweaked, I recounted my micro chart and think we are topping here. So in my opinion, that was a confident shorting setup. I'm not going to explain you the whole technique I used here, because you may know that I have a video course and tonight I'm posting a detailed explanation of what I did here and what technique I used and what specific ratio I used. Because if you want to learn the technique, you need to take a course and it's very detailed, it has a lot of videos, so you will be able to do the same. There is no rocket science here, believe me. So let's come back to what actually I tweeted and what was going on in the market. So on February 4th, the next tweet, I said that was the time to think about puts. And why I posted the chart of TVIX, it's TVIX, it's my typo, sorry. So this is a fund which invests in futures on volatility. And it's very important if you want to buy puts to understand what's going on with volatility regime, because the lower volatility is, expected volatility is, the lower the price for your puts, because volatility is a significant component of the price of your options. And from this chart, I pointed attention of my followers to similarity between two fractals. So here in first quarter of 2018, we got a huge spike and then it dropped down, retracing on more than 76.4%. So here I found a very similar structure when we got that spike starting in December and topping in the beginning of 2019, and then similar sharp drop into the same area between 76.4 and 85.4% retracement of that spike. That was additional confirmation that we might be topping. I also posted another chart where I pointed to a similarity between different bottoms of volatility. What I noted that normally volatility bottoms out with small daily candles, so-called dojis, the sign of indecision in the market. So here it bottomed with doji, here it bottomed with doji, and couple of dojis here, two more dojis here, another doji here, and finally we get two daily dojis this week. So that's a great sign that market may be topping and volatility may be bottoming. So every time market keeps moving up and you want to buy puts, but you see that volatility is crashing down, meaning that you have a full-bodied red candle on a daily chart, you should stop yourself, like here, you see, because when volatility keeps moving down, the value of your puts evaporating very quickly. So your puts may lose 30-40% of their value in a day. But when you get the doji after an extended move down, so that's a sign that bears are exhausted, bears in volatility are exhausted. So that might be an additional confirmation for you when you want to counter trend the bullish move in the market. So this is what happened to my own orders. So when I tweeted about possibility of topping the market, I personally added a lot of orders into the system. I call those orders stinky bids. Why? Because I'm not prepared to pay the price they offer me at that moment. So we always think that if we have a feeling that the market is stopping, we should immediately short it. And in majority of cases, we are proved wrong, because those shrewd option dealers, they simply know better. They have math models calculating the real option of the price, the risk of reversal, and they normally want you to overpay for puts, maybe 20, maybe 30, sometimes 50%. So when your emotions kick in and you want immediately to load on puts, you should stop yourself. And yes, you can enter orders, but what you should do, you should put lower prices. For example, if the put you want to buy is traded as 120 at bid and 125 at offer price, what I would do, I would add 0.98 cents per put, meaning that I add my order 20% lower than the current bid. Doing that, I create so-called margin of safety. So if I'm wrong about the moment and the market will move up, or even if the market stays at this level at the top, the option, the premium for the puts would keep moving down. Any additional spike would immediately lead to decrease of the value in your puts by 20%, 25%. So any additional spike, and we normally see those crazy spikes at the very end of the extended move up, your stinky bids will normally get filled. And this is exactly what happened to my stinky bids. As you can see, this is the timestamp when I entered those orders into the system. That was between 12:17 and 12:29 lunchtime. But they got filled only 3.5 hours later, right at the close of the market, at 3:57, at 4 p.m. and some of them got filled the very next morning at the open at 9:30. Then we got that spike up. I wouldn't say that that was a perfect entry, because I will show you later that at some point of time all my puts were underwater by 20%. When you buy puts with stinky bids, it's very important for you to be emotionally prepared that you will not get filled. You may not get filled, guys. You have to accept that. So there should not be any fear of missing out. So I'll just give you an example. So in blue, you see my orders which got filled. In yellow, you see my orders which did not get filled. They just got expired. If I got filled, I would have made 2 times, 3 times more money. But I don't care. I'm grateful for the money I made. This is how you should approach the situation. So you should always be prepared that you had a nice setup and you failed to execute on it because you were too greedy to when you set the price for your order. That's okay. That's why normally you should use several tranches. What I should have done, I should have divided all those orders into 2 groups, and the first group to use the same principle as I've just explained to decrease the price by 20%, but the second group should have been set at lower prices. I should have decreased it by 40%, and it would have been filled because we know it now. But that was my mistake. I just put too many bids at basically the very same price level. So this is what happened after my tweet. So we started the decline and I tweaked the microstructure, looks complicated, and today Russell futures hit my target short area. And this is what happened next. You can see that the first sharp drop in subwave A followed by a very same sharp rally in wave B, and this is where my puts went underwater. So you can see that despite the fact that at this point we made a lower high in comparison to the very top of that wave CO5 of CO5, my puts went underwater because at this point option traders thought that because the market returned back that fast and that decline got bought out, the risk of breakdown significantly decreased. And that is why we do not need to charge that much money for the puts. So they thought that selling puts was a slam dunk trade for them. And this is, you can see that basically it's never too late to buy puts on a pullback. So even if you were late to buy them here, the very first pull gave you even better opportunity to buy puts than I did that, even though I correctly predicted the top. What happened next? We got ABC down, that was our wave 1 down, then we got ugly pullback and wave 2 down, and then another move down. So I thought that was the bottom of wave A of 3, and I expected a pullback in wave B of 3. And that was a small mistake, because it turned out that that was bottom of A, that was bottom of B, and that was the start of wave C of 3. And wave C of 3 is always the strongest part of the move, either it's decline or rally. So here you see that almost vertical drop, and this is exactly how normally wave C of 3 looks like, either it's going up or down. So it always is stronger than the first leg of the wave 3 in subwave A of 3. And this is where I sold my puts. I normally sell my puts when I expect the bottoming of the wave C of 3, because such a sharp drop makes option traders very nervous, and we just put away the offers for puts. We just not sure when the drop can stop, and this is when you have a huge gap between bids, meaning orders to buy, and available puts on sale. This is when you put your puts on sale, and you can get really good price with a nice premium to the real value of those puts. So I sold them there, and I expected that the price would come back up to this point in corrective wave 4 up. And I figured that pullback to over 1500 would be awesome opportunity to reload shorts. So we got move up here, and at this point I started to add my stinky bits again. I wanted to reload my puts. So at this point I was ready to buy puts again, but I knew that it would be too late. So again I added my orders with 20% cheaper than the current bids at that moment, and I got filled on one order right at the close, even though I did not watch the market by then. By 2 p.m. I was gone, I did not pay attention, but my orders were in the system. So then we got expected drop because of the top of wave 4. We should get the final move down in wave 5, and it is always subdivided into A down, B up, and C down. So the first drop in wave A of 5 normally targets the previous bottom made in wave 3, but normally it's weak enough to make a new lower low, so it's either retested or just stalls somewhere close to the previous bottom, and then we get another bounce in corrective wave B up and the final decline. So this morning on Friday, on February 8th, we got that huge spike. So this is structured as A, B, and C, and when you have such a sharp move up, so normally it's a good sign that it's a corrective move. And this is why I was pretty confident to tweet that so Russell is still under the critical resistance of 1509, and as long as it holds it, so we should get another decline. So it's a textbook pattern. I explained that pattern in details in my video course, and it's great to learn harmonic Elliott waves because it gives you great understanding what are your critical supports and resistance levels are. So this is what happened next. We got that sharp drop. Unfortunately, it was unable to make a new lower low, and as you can see here, I expected that it would drop here, but it stopped there. And it can be explained because here you can see a very important moving average. It's 1000 period moving average, and I knew that price can find support here, and it was unable to break it down. And at this point, easy money are made. So at this point, instead of counting it as 5-wave structure down, we now need to find another way to explain what happened. But before I explain what is my current view, I should tell you that in 2 days will be my happy birthday, and because of that, I set 50% discount on my video course Predict the Market with Harmonic Elliott Wave Analysis. So that discount is valid only until midnight of Sunday, February 10, 2019, for only 10 first students. So this is the home page of my video course. It is published on a platform called Udemy, and you don't need to know anything about wave analysis. I will teach you from scratch, and hopefully you will be able to analyze the market in the way I do it. So the regular price is $99.99, and you now pay only $49.99. This is the price for lifetime access. You pay only once, and you will be able to watch and rewatch those videos and download PDF files with all the charts through all of your life. Now it has over 120 short videos, so each video is about 2 or 4 minutes, and each video explains either a theoretical subject or an actual case where I show you how those typical classic patterns would help you to pinpoint either top or bottom or the next move in the market. I will give you a link to the course in description of this video. Again, use coupon birthday1 in capitals. The video will teach you all the basics, and you will be able to download videos in the Udemy app to your smartphone and tablet. And if you have any question about any subject of the course, I will be more than happy to help you with that. So coming back to what happened, because the drop down did not make a lower low, so we can no longer call it the fifth wave, and subsequently we cannot longer consider that structure as 5-wave down. So now we can say that that was ABC of A, B up, and C down, and that was the first move down, subdivided into 3 waves in a larger wave A down. From here we should get ABC of wave B up. That ABC was A, then A, B, C, so we can get another drop by open on Monday, and that would be subwave C of parenthesis B, and then another rally which may target somewhere here, retracing 66.7, 61.8, 76.4, or even 85.4% of that whole decline. We get another ugly wave B up. Waves B are famous for having an ugly structure, being hardly predictable. And so here we got an easy entry because we could get an impulsive structure of the final wave C up. Here we would not get such an easy entry. Let's see what happens, but so far we see that trend line, red trend line, has held twice, and that important moving average in magenta color has held twice. Bulls still have the ball in the game, so we control the game, and as long as we stay over those two lines, we should not be super bearish. But once we break down that line, then we can be more aggressive with shorts. So far, as long as that potential move up holds under that previous stop made this week, I still think that what was only the first leg down, and I still consider those two levels as two main targets for the next move down. this is how my website looks like. If you go to www.costofaytrader.com/market-analysis, you will see all my recent posts. Not only that, if you scroll down my homepage, www.costofaytrader.com, you will find Text Cloud. It's a very easy, convenient way to check the latest updates on some specific symbols. So this is it. Good luck with your trading and stay tuned and check out my updates.